I'm Tom Alonji, 30-year Wall Street veteran, and this is Tom Alonji Forex, the site where we crush trading myths and reveal how the pros really trade. Subscribe for real strategies, real trading mindset or psychology, and zero hype. So let's get right into our first little video on our site here. Stop trying to catch the bottom in Forex or crypto and do this instead. Every trader's dreamed of this moment. You catch the very bottom of a huge move in your favor. You buy right before the price reverses and you watch the candles or the bar charts fly in your favor. But let's be completely honest. That's not trading, that's just wishful thinking. So stop trying to catch the bottom in Forex and do this instead. Now, I know every trader's dreamed of catching the perfect bottom, buying right before the price rockets up. But in reality, that dream is really nothing more than a nightmare that empties accounts faster than any bad trade setup. You see, in Forex or any trading, bottoms aren't price levels, they're processes. Trying to catch one too early is the fastest way to drain your account and your confidence. Emotional capital is just as important as trading capital. As a matter of fact, I'm going to get to that later on in this video, but that's it. I believe that emotional capital is more important than your trading capital. You can always put more trading capital in, but if you drain your emotional capital, you're going to be finished as a trader. So the real opportunity comes after the selling pressure ends, when the market structure shifts and the banks quietly flip direction. And today, I'm going to show you exactly how to recognize the shift before the breakout even begins so you can enter with precision and not hope. So, professionals don't call bottoms. They identify where selling pressure has completed, and they wait for the market to prove it through structure and liquidity behavior. And I'm going to show you, and here's the setup right on this chart right here. We could see on this, what I'm trying to show you in that little paragraph that I just said to you was that we had a downward moving market, right? We had a low right here. We had a lower high. Market broke down to a lower low right here. Then all of a sudden, the marketplace starts coming up and starts consolidating. We're going to be going over that in this video, so you're going to actually understand, exactly what I'm talking about. So, really, this is where the opportunity lies for traders when the market starts consolidating. And we're going to give you the clues as to what to look for so you can actually enter with precision. So, why do so many traders still try to pick bottoms? Because they see a pair that's fallen hard and they think it can't go any lower. That's what's known as psychology as an anchoring bias. You're comparing price to where it used to be instead of to where it actually sits. The market is never wrong. It is the judge, jury, and executioner. Where the price sits, that is the true price. If it wasn't the true price, it would be someplace else. So anchoring bias is probably one of the primary reasons that people do it. So the thinking behind is they compare price. Like for instance, if we're looking at this chart, you're comparing price. Sterling dollar was originally at 137. It's sitting at, it goes down to 133. You watch the rally up to 135. They go, aha! I knew that the thing was, because of, just a couple of hours ago, it was much, much higher. So what am I going to do? I'm going to start to like look to buy bottoms. So you buy here. Okay. And you throw a little bit of pride into this, and now you have a recipe for unnecessary losses and disaster. So, really, what we're looking and what we're describing to you is really the downward death spiral of a market. And you got to look for the right clues. And, markets will turn, but they're going to turn on their time, not on your time. All right, so let's just recap this, okay? Just several hours ago, you saw the market at 137. Market fell down to 133, re-rallied up here again. This basically gives you the anchoring bias. And because you're looking at the market from the last perspective up at the high, you're thinking, oh my gosh, I knew that this marketplace was going to turn around. So what do? You basically start buying in here, market falls lower, you buy in here, market continues lower until finally you scream uncle. So you add in a bit of pride and you add in your past frustrations and you got what's known as a recipe for disaster. Okay, so you're really entering, as I just said, you're entering the downward death spiral, and that's not a place that you want to be. So, really, what we're saying is that what usually happens, let's say, I'll just use euro dollar for example. I use sterling dollar, right? Sterling dollar actually falls from this point down, to this level down here. So it fell, let's say, 150 pips. Okay, and it's done it in just a few hours. Okay, so you think it's oversold, so you buy this level right there. Now, all of a sudden, the marketplace starts drifting lower again. Right now, what's happening is your account's bleeding. You're emotionally, almost finished. Now, look at this is why I said in the beginning that emotional capital was much more important than trading capital. So, because if you continue to deplete your emotional capital, you begin to not trust yourself and you end up an emotional wreck. You're unable to pull the trigger. You start second guessing yourself. You don't trust your system anymore. You start flying from one system to another system. And before you know it, not only are you emotionally destroyed, but you're financially destroyed. And then you start to muster up, well, should I pull some more money up together trading? But, now you have a psychological block because you don't trust yourself anymore. And I'm telling you, emotional capital is much more important than trading capital. Look, if you have a system and you're following it and you take losses, that's normal. Trading without losses is like living life only breathing in and never breathing out. So it's part of the game. Our job is not to avoid losses, it's to control them. So that's the point that I'm trying to make. All right. So the truth, downtrends are like strong currents. You don't fight them. You wait until they start to slow down, they shift, the structure changes a little bit and it shows signs of like institutional accumulation. So again, professionals don't call bottoms. They identify when selling pressure has completed and they wait for the market to prove it through structure and liquidity behavior. So what do professional traders do differently? Well, the main thing is that pros understand patience, right? It's right there. But what professionals do differently is that pros understand that patience is a position. They don't try to catch falling knives. They wait for the market to prove that it's done falling. They look for exhaustion, momentum fading, volume starting to dry up. As a matter of fact, you want very, very small volume when you're in consolidation zones like this. Small, like low volume is very, very good in here. It means that the pros are quietly accumulating. All right. So they look for exhaustion in a marketplace, like where the momentum's fading, and the price is building a base. Price is building a base. We're going to get into specific examples in a second. But really, what I could show you is I could show you like classic accumulation phase, Wyckoff accumulation. Generally, what you're seeing is you're seeing volatility, shorter wicks. Often you see one last spike, which is also known as a spring, right? A Wyckoff spring before a reversal happens. So we're going to be going into that in a second. I'll be showing you some of that stuff right now. But you got to understand that it's not luck. The timing of a professional looks perfect, but I assure you, it's not luck, it's discipline. And while the crowd is busy trying to pick the bottom, okay, what we're trying to do is we're staying quietly on the sideline, watching and waiting, preparing for the confirmation that we need. And the market doesn't reward the first mover, it rewards the most patient one. So, what's actually happening in a downward moving market? Okay, let's get into that. What's exactly happening? Every fall has like three phases, right? So every collapse like looks chaotic on the surface, but underneath it's just a story written in three quiet phases. First phase is like panic liquidation. The market's up at top. Look, I'm sure there was a lot of volume up here because this was probably stop loss running and also late buyers. And then all of a sudden, this is basically now I'm going to move to a bar chart. Okay, I want to just change over to a bar chart. The reason I moved to a bar chart because it's easier to see the closes for me. I don't generally use candlesticks, You can, obviously, a lot of people do. A lot of that's the flavor for these new traders, but really I'm a bar chart guy. So really what we see here is a spike up. Okay. And I'm going to show you some. I'm going to give you a little bit of a little piece of something that you could look at where you can actually see where a marketplace is potentially saying that the top is in or could be potential top. When we're comparing two up bars, or you can look at two up candles, but you need to know where the closes are, right? If you look at the distance between this close and this high, okay, and you compare it to the distance between this close and this high, the most recent bar, there's a lot more traders because the difference between this close and this high is much greater than this close and this high. Then there's a lot more traders that are trapped here. So as soon as the bottom breaks, this is when the crowd like loses control and the stops start getting triggered. Okay. Fear takes over. It's not analysis for the masses anymore. It's survival. However, the pros are calm because if you would have learned it just in this little simple trick that I used to call the head fake trick, difference between the close in this the close in this high and the close in this high. Since this is greater, this top should hold. Once the bottom breaks, we're starting to get that panic. Okay. Now, what happens next? Well, the next is where retail traders are starting to bail out. They're all bailing out. Institutions are quietly stepping in right here. Okay. And this is like one of the boxes I'm going to show you again. This was basically the big boys starting to accumulate again and starting to absorb all of the retail selling to them. Quiet, methodically, they're taking the other side of despair and they're collectively, they're really collecting the very liquidity that panic created in the market. So if we look at let me go to the next slide here. Slide accumulation versus hidden resistance, right? So right now, what's happening right now is, when you're getting the accumulation in here, okay, the sideways ranges build this is where the banks build positions. Now they have their stop down by the low. Now they also know that some of the bankers can actually do, what's known as they look for the last bit of liquidity. So sometimes the big boys will spike the price down, like where you see this, right? Where you get that spike one, the final clearing, of the weak longs before the reversal up. That could possibly happen. So banks are very, very well aware of that because what you have to also understand is that, we could have some type of like this. This is the accumulation phase. Okay. This is Wyckoff, right? The Wyckoff accumulation phase. This is the spring before the breakout. So let's get back onto this chart. Okay. The first thing that we have to notice in the accumulation area is the storm is fading out. Okay. The volatility died down. Price stopped falling. The market starts breathing again. And in that silence, when nobody's watching, the real reversal begins. It's not in the fireworks. It's in the stillness. Now, okay. So where in this chart would you think you could actually start to see the start of the accumulation or the start of the movement up? Well, right here you have the low. You got a high. You don't have a higher high than, this top yet. When you come down, look at this. You're making a higher low. That is the first idea that you have potential that the market could break out upward. Now, also, you can start looking for like that head fake on the bottom side too. You could actually say, okay, look, I got a down bar right here. Closed to low is 0. Closed at the low. My next 6 hour came down, made a new low, but closed higher. The difference between this close to this low is greater. This bottom should potentially hold. Now, it's not guaranteed, but it's a good indicator. So once you see this slight confirmation, then you say the rally higher and then the higher bottom, you got something here. Now, the breakout will actually occur up here. So I can actually move this down like right there. That would be the good break, the start of the movement up. So in this area is where the professionals come alive. They're not chasing bottoms. They're waiting for proof that the selling is over and the next movement upward is about to begin. So we come on over, we're going to look at where we're spotting the accumulation zone. I'm basically showing you where to spot the accumulation zone right there. What does it look like? Is volume drying up near the lows? that's important. We need the volume to start to slow down. Now, in Forex, you could say, well, I don't get volume. Well, you got your broker's volume, but really you could be using the wicks. You could be, or you could be using the bars. Let me go back to the candles, which I know you guys have, you like. Okay, you can start using the wicks. You notice how the wicks aren't getting deeper, and also the candles getting tighter. So it's a series of equal lows that you could potentially get a false breakdown from, or a structural shift. You get the first, higher break, the break of market structure, which occurs right here, because this is the true, like, you could say this is the first level breakout, but truly, like, you got to get up through this level. That was the old high before the marketplace broke out higher. And then, of course, you need to look at that. But one step at a time. I'm just trying to give you an idea of where you could see the structural shift happen. And this is a good example of it right there. What the main example is actually you're looking at, see, the close to the low here is 0. The close to the low here is greater. Therefore, the bottom should hold. You're also getting like a higher low right there, and then you get the breakout. That's a good place to really get involved and look to basically get in. All right, so now let's move on over really what's like the meat and potatoes of the whole thing. So the liquidity dry up, right? So I'm going to show you on a chart. Let me get over to a chart. This is classic. Like this is classic. This is the liquidity dry up perfectly. Now, when the marketplace has broken down, you're starting to look for actually, tightening like candles, right? Often you're going to see that one last spike down, a liquidity grab to clear the weak longs out before the reversal happens. Okay. Now, I'm going to let me add a line to 135. What? 135. Right there, 10. There's the breakout right there. The structural break right here occurs when actually the momentum is shifting in this marketplace. So the market was showing, and at first the market's out of fuel, and then, the structural break actually happens. And this is what we're showing here, right there. Once the market bursts above the range with a strong close, momentum has shifted. So you enter on a retest. You enter on the retest. This marketplace actually broke out right up in here. Okay, here was the retest, and then it took off from there. So you're not catching a bottom. Okay, you're confirming the new trend. You're confirming the new trend. So let's move over to, where we can actually show you a complete example. Let me find a good chart to go to. Okay, sterling dollar drops from 134.45 to 131.41. Then it starts to base in between 133. Where's 133? Right here, 133.50. Let's put a line up there. We don't have it up there. 133, say, all right here, 133.50 and 132. 132.50, 133.53, like that. It's basing in between these 2 points. Okay. Now, if you notice in this area, we're actually looking for like one spike down. That would be good to clear out. It doesn't really happen. We're not getting, the normal like that. Okay, that's fine. But what we are getting is just the market is consolidating. Okay. Now, once the market breaks 133.53, 133.55, okay, you're looking to buy the retest. You're looking to come in and buy the retest, which is happening right in this area, right? Now, there's many ways you can use it, okay? How you could do it. You could actually do like a fib retracement. You could look to buy a fib with a stop below the fib, or if you're just, you're very, very comfortable with your trading system, you actually buy the retest and you put a stop below the 132.55. That's a 100-point risk. So you need at least 150, 200 points profit. But once the market breaks 133.53 and retest, it then rallies 150 pips in your favor. So if you do use the fib levels, and I'll do another video like with that showing how you can use fib levels to buy it. You got a very small risk with asymmetric reward. So it's proof over prediction. Proof over prediction. So what I'm saying here is trading is definitely not about being first. It's not catching the last tick. It's about being aligned with the flow of the liquidity of the money in the marketplace. Amateurs constantly chase reversals out of fear or just plain excitement. Okay. Trading is not about, excitement. It really, if you're looking for excitement, you should just go pick up a hobby. Trading is a business, right? You got to treat it like one. But um, if you react from emotion, you're early and you're probably usually wrong. That's for sure. When you wait for confirmation, you stay calm, disciplined, and aligned with the real trend. The goal isn't to catch the exact bottom. It's to ride the turn once it's proven, because the turn's going to be strong. It's going to be good. It's going to be at least equal to the value of where the marketplace came from. Generally, that's market geometry, where you can have like the top to the bottom, and you generally get the same amount of run upward and perhaps even greater, like a 1.618 extension off of it is a truly strong movement. So you want to stay in there as long as you can. You want to hold on to your winners with both hands in your teeth. That's for sure. So again, the idea is to actually ride the turn once it's proven. Now, your new rule has to be that you do not predict turns. All right? That's your new rule. Stop trying to catch the bottoms. Let the market reveal when sellers are finished. Very important. Act with precision and confidence. Have a good stop loss and use good money management. So stop trying to catch the bottoms, okay? Let the market reveal when it's over. Act with precision and confidence. Again, I'm saying it again. The goal isn't to predict, it's to recognize when the control shifts and ride the waves like a pro. Because in trading, patience pays more than prediction ever will. If you like what you see in this video, please give a like, give a subscribe, leave a comment. Tell me if you're into Wyckoff. Tell me what you'd like to see more of. And I look forward to seeing you again on Tom Alonji Forex. It's been a pleasure. Cheers.